As the United States implements a new round of tariff measures, businesses are grappling with rising input costs and increasing uncertainty across supply chains. Do these policies truly protect the national economy, or are they placing undue strain on consumers and small enterprises? Since early 2025, the U.S. Department of the Treasury has confirmed that tariff volatility is an intentional part of the Trump administration's trade strategy, aimed at keeping partners like China, Mexico, and the EU off balance during negotiations. However, the approach is drawing concern. Thousands of U.S. firms report they cannot plan long-term, with tariffs shifting from 30% to 145% within weeks. An internal report from the American Trucking and Logistics Association, a TA, showed that in April 2025, when the 145% tariff on Chinese imports was active, import orders dropped 46%, leaving goods idle and prompting factory shift cuts and temporary layoffs. When the rate fell to 30% in May, orders surged over 50%, causing congestion at major ports including Los Angeles, Long Beach, and Houston. For consumers, this volatility means erratic prices and potential local shortages, especially for seasonal goods like electronics, school supplies, and apparel. Retailers warn that ongoing floating tariffs could disrupt quarterly supply cycles, raise prices further, and undermine consumer confidence. On May 20, 2025, Jamie Dimon, CEO of JPMorgan Chase, warned that new import tariffs are too extreme and their full market impact has yet to surface. With rising input costs, persistent inflation, and slowing growth, he flagged a growing risk of stagflation. Dimon emphasized that 50% of U.S. imports are raw materials and components vital to domestic manufacturing, not just finished goods. Tariffs of 30 to 145% are driving up production costs, forcing businesses to raise prices or scale back. He also warned that key allies, including the EU, Canada, and Mexico, are increasingly turning to trade deals with China, signaling a global shift. A report by the International Chamber of Commerce, ICC, showed U.S. exports to G7 nations dropped 7.8% in Q1 2025 amid concerns over unpredictable U.S. policy. Dimon's remarks point to mounting financial strain. With high interest rates, tighter credit, and shrinking household budgets, middle and lower-income Americans are bearing the brunt. Subaru confirmed it is raising U.S. vehicle prices, as over 50% of components in its Outback model are imported and now face steep duties. Price increases range from $750 to over $2,000 USD per unit. Ford and other automakers are making similar moves, while the number of new vehicle models priced under $25,000 USD has dropped 32% in just the first half of 2025. In retail, Home Depot has kept prices stable on some items but discontinued lower-priced products due to shrinking margins. As a result, many basic goods are vanishing from store shelves, especially in low-income areas. For small businesses, the strain is greater. Beth Benieke, CEO of Busy Baby, Minnesota, launched a crowdfunding campaign to cover $48,000 USD in unexpected tariffs on a shipment from China. Although rates later dropped to 30%, delays during the critical holiday season disrupted the company's entire fourth quarter. Consumers now face higher prices, fewer options, and reduced access to affordable goods, making household budgeting and essential purchases more difficult. For the first time in over a century, the United States no longer holds its historically top-tier credit rating. Is the global economic balance of power now shifting into China's hands? On May 16, 2025, Moody's officially downgraded the credit rating of the United States from AAA to A1. This marks the first time since 1919 that the U.S. no longer holds the highest rating from all three major agencies, Moody's, S&P, and Fitch. The primary reason? A rapid rise in national debt, projected to reach 134% of GDP by 2035, if no significant corrective measures are taken. At the same time, 30-year U.S. Treasury bond yields have surpassed 5%. the highest level since October 2023, reflecting declining confidence in America's ability to manage its debt. For ordinary Americans, this downgrade is not just a Wall Street issue, it means higher interest rates on mortgages, auto loans, and credit cards. For retirees and those on fixed incomes, everyday expenses may become more burdensome as borrowing grows more expensive without any rise in income. At the same time, China, once the largest foreign holder of U.S. Treasury bonds, has reduced its holdings to $765 billion, the lowest level in years. Notably, China has now fallen behind the United Kingdom in total U.S. debt holdings, signaling a strategic shift in financial policy. This sell-off reflects diminishing confidence in the U.S. government's fiscal control and long-term economic stability. If this trend spreads to other countries, such as India, Brazil, or major European investment funds, the U.S. could face an uncontrolled rise in interest rates. For consumers, 3 question marks. That means higher borrowing costs across the board, from homes and vehicles to everyday credit, placing even more strain on household budgets and long-term savings. The Trump administration is currently advancing large-scale tax cut packages projected to add between $3 trillion and $5 trillion to the national debt over the next decade. Meanwhile, revenues from trade tariffs and customs policies have fallen short of expectations, leading to a widening budget deficit. With rising expenditures and insufficient revenue, the U.S. faces a difficult dilemma: borrow more to cover obligations while facing higher interest rates. If this pattern continues, the federal government may be forced to make cuts in sensitive areas such as healthcare, Social Security, and education support. For older citizens, these changes could weaken access to public services, disrupt Medicare benefits, and erode essential post-retirement support systems. The loss of top-tier credit status affects not only the federal government, but also has far-reaching implications for businesses and the broader economy. Higher borrowing costs mean rising investment expenses for companies, especially small and medium-sized enterprises that depend heavily on bank financing. Some may be forced to scale back production, reduce hiring, or pause expansion plans, impacting the labor market directly. Consumers will feel the effects too, through rising product prices, as companies try to offset increased financial burdens. This comes at a difficult time, with inflation still elevated and household purchasing power under pressure. Internationally, more countries, especially central banks, are shifting reserves toward gold and the euro, moving away from U.S. treasuries. This signals the emergence of a new global financial order where the United States may no longer hold its central role as it once did.
President Donald Trump has stirred significant discussion in the political arena with his pragmatic foreign policy approach, where the United States, China, and Russia dominate global influence. The question remains, can this strategy reshape the global order? Or is it a risky move by Trump? In early 2025, President Donald Trump proposed renaming the Gulf of Mexico to the American Gulf, arguing that the region holds strategic importance for the U.S. He emphasized the Gulf's vital role in maritime trade and resource extraction, particularly oil and natural gas. This proposal caught the attention of the Mexican government, with President Claudia Sheinbaum expressing concerns that the name would be inappropriate and disrespectful to the region's historical heritage. Mexico has since made efforts to protect the name Gulf of Mexico on international maps. Throughout his presidency, Donald Trump developed a unique relationship with Russian President Vladimir Putin, even amid escalating tensions over the situation in Ukraine, where Russian forces continue their offensive. Meetings between Trump and Putin, especially the 2018 Helsinki summit, sparked controversy among international observers. Trump not only refrained from criticizing Putin for his interference in the 2016 U.S. elections, but also proposed closer cooperation between the two nations. Recently, Trump has again criticized U.S. foreign policy, suggesting that he might be the only leader capable of resolving the Ukraine conflict swiftly, though many view this stance as unrealistic, given the ongoing conflict and unresolved tensions between the two nations. Trump's leadership style, often described as transactional, has raised considerable debate. Throughout his term, he predominantly approached both domestic and international issues from the perspective of personal and national interests, rather than moral values or long-term leadership principles. He frequently sought short-term deals beneficial to the U.S. A clear example of this was his approach to trade relations with China, where he imposed high tariffs on Chinese goods, relying heavily on the power of sanctions and tough negotiations, rather than seeking long-term cooperative agreements. His views and actions have not always been predictable, and their instability has led to concerns about the absence of an overarching strategy in foreign policy. Donald Trump has made notable efforts to facilitate ceasefire agreements in the Middle East, particularly in the Israel-Gaza conflict. One of his significant actions was negotiating and facilitating a ceasefire agreement in early 2025 between Israel and Palestinian forces. However, his proposals, especially regarding Gaza's future, met with strong opposition from hard-right Israeli groups, who criticized him for not adopting a tougher stance toward Gaza and Palestine. Despite these reactions, rumors suggest the possibility of a new ceasefire agreement, potentially tied to Trump's upcoming visit to Saudi Arabia next month. President Donald Trump holds a clear strategic vision for the global power structure, which he believes will be dominated by three major powers: the United States, China, and Russia. In Trump's view, these nations will take center stage in global affairs, with the U.S. intervening in strategic regions, including the Asia-Pacific, the Middle East, and Europe. He focuses on safeguarding American interests, particularly through hardline trade strategies with China, aimed at reducing trade deficits and protecting domestic industries. Simultaneously, Trump has shown a degree of support for Russian policies, especially in Ukraine and Syria, reflecting his pragmatic foreign policy approach that prioritizes short-term agreements. Financial markets are rattled as the U.S.-China trade conflict enters an unprecedented phase. Interest rates are climbing, and the U.S. dollar is losing ground. What lies ahead for the American economy? As of April 11th, U.S. financial markets have experienced notable declines. The S&P 500 has dropped 8.8% since the start of the year, while the NASDAQ composite has fallen 13.4%. The Dow Jones Industrial Average is also down 5.5%. Alongside equities, the yield on 10-year U.S. Treasury bonds has climbed to 4.5%, reflecting concerns over inflation and potential future interest rate hikes. The U.S. dollar has weakened, particularly against the euro and the Japanese yen. In contrast, gold prices have increased as investors shift to safer assets in response to currency depreciation and ongoing market instability. Over the past week, President Donald Trump announced a significant increase in tariffs on Chinese goods, bringing the total rate to 145%. This includes a 10% base tariff, a 125% reciprocal tariff, and an additional 20% aimed at addressing fentanyl-related issues. These measures are intended to encourage domestic manufacturing and reduce reliance on foreign supply chains, especially in critical sectors such as semiconductors and pharmaceuticals. China responded by raising tariffs on U.S. imports to 125% and stated it would not escalate further, regardless of future American actions. Additionally, China has imposed restrictions on the export of key resources like rare earth minerals, impacting U.S. defense and high-tech industries. These developments have contributed to global market fluctuations, with record gold prices, rising bond yields, and a continued weakening of the dollar. Across Europe, several countries are actively exploring deeper economic ties with China. Recent talks and agreements between the European Union and Beijing underscore a growing shift in international trade dynamics. One prominent area of cooperation is the electric vehicle sector. The EU and China are discussing the implementation of a minimum pricing mechanism for Chinese EVs imported into Europe, which could replace the current high tariff structure. Previously, the EU imposed tariffs of up to 35.3% due to concerns about state subsidies, but the ongoing negotiations aim for a more balanced and sustainable solution. Beyond EVs, discussions are also advancing in renewable energy and clean technology. During a recent visit to Beijing, Spanish Prime Minister Pedro Sánchez highlighted the importance of strengthening bilateral trade and investment in these emerging sectors. President Trump came under scrutiny last week following a social media post made on April 9th via Truth Social, in which he stated, "Now is a great time to buy," alongside the stock symbol DJT, referring to Trump Media and Technology Group. Just hours later, the administration announced a partial delay in retaliatory tariffs, maintaining a 10% base tariff on most trading partners. The timing of the post prompted concern from several Democratic senators, including Chuck Schumer and Elizabeth Warren, who have called on the SEC to examine whether the post may have provided an unfair advantage to those close to the president. On April 9th, DJT shares surged by 21.67%. Additionally, a video shared by White House communications aide Margot Martin appeared to show President Trump suggesting that some of his associates had benefited significantly from the market activity, raising further questions about potential misuse of privileged information. According to data from Freddie Mac, the average 30-year mortgage rate in the U.S. has fallen to 6.62%, marking the third consecutive week of decline. Despite this, broader economic sentiment remains fragile. The University of Michigan's Consumer Sentiment Index dropped to 50.8 in April, down from 57.0 in March, reaching its lowest point since 1981. At the same time, short-term inflation expectations rose to 6.7%, reflecting growing concerns over rising living costs and economic uncertainty. Major financial institutions, including Goldman Sachs, have revised their outlook, raising the probability of a U.S. recession in 2025 to 35%. These projections are driven by the combined impact of trade policy uncertainty and continued market volatility. Car prices are rising, jobs are gradually disappearing, and Americans are struggling in the midst of a shifting economic landscape. What is happening to the auto industry, once the pride of the United States? Tariffs and protectionist trade policies have driven production costs sharply higher, pushing the price of American-made vehicles to record levels. According to Edmunds, by early 2025, the average price of a new car has surpassed $50,000 USD, while used vehicles are nearing $32,000 USD. With incomes failing to keep pace, many consumers are left with no choice but to hold on to older cars, even as maintenance costs continue to rise. Cox Automotive reports that a standard oil change, once around $50 USD, now exceeds $100 USD. Hourly wage earners and those on fixed incomes are bearing the brunt of this burden, particularly as broader living costs, from groceries to gasoline, rise in tandem with the new wave of tariffs. McKinsey notes that 75% of American consumers have shifted to buying cheaper goods, primarily food, due to tightening household budgets. At the same time, unemployment is spreading. The manufacturing sector is seeing a jobless rate of 5.2%. Construction has shed 34,000 jobs. In agriculture, has experienced a 3.8% reduction in its workforce. These losses stem from rising raw material costs, declining export demand, and widespread order cancellations, all of which are forcing families to cut back on spending, weakening purchasing power across the broader economy. As American car prices rise and deliveries slow due to parts shortages, Japanese and Korean automakers are gaining ground, thanks to competitive pricing and more agile supply chains. In 2024, Toyota captured 12.5% of the U.S. market. Hyundai Kia held 10.2%, and Honda accounted for 8.1%. These vehicles are known for their durability and fuel efficiency, qualities especially valued amid the steep increase in fuel prices, driven by new import tariffs. Hyundai has announced plans to invest $21 billion by 2028 to build electric vehicle and steel manufacturing facilities, expected to create an additional 100,000 jobs and stimulate regional economies. In contrast, many American automakers have been forced to scale back production due to rising costs, leading to widespread layoffs. This has reduced consumer access to domestic models, while further pushing up the price of American-made cars. The shift toward Japanese and Korean vehicles also reflects a broader trend, a trend toward more frugal consumer behavior, with U.S. economic growth projected to slow to 1.4% in 2025, down from 2.2% previously, according to McKinsey. Many Americans are adjusting their spending habits in anticipation of leaner times. The 25% import tariff has driven up car prices by an average of 13.5%, or roughly $6,400 per new vehicle. This price spike not only strains consumers, but also directly affects manufacturing and exports. Ford has halted exports of the F-150, Mustang, and Bronco to China in response to retaliatory tariffs of 150%. Stellantis has laid off 900 workers across 5 plants, while Volvo has announced job cuts ranging from 550 to 800 positions. Current trade policies are weakening the U.S. auto industry, leading to declining revenues, job losses, and reduced access to domestic vehicles for American consumers. Without timely adjustments, U.S. market share for American-made cars could fall below 40% within the next 5 years. The inflationary pressure driven by tariffs is also spreading to other sectors. In agriculture, the unemployment rate surged to 12% in March 2025, the highest in years. This reflects the broader, cascading impacts on the overall economy and the daily lives of millions of Americans. Canada is severing vital ties with the United States, from energy and security to politics. What is happening after the statement? Canada is the 51st state. And why are citizens calling for national self-defense? Manitoba Hydro, one of Canada's major energy providers, has terminated 2 electricity export contracts to the United States equivalent to 500 megawatts per day, following former President Donald Trump's announcement of a 25% tariff on Canadian energy and goods. The redirected power will now serve domestic regions such as Nunavut, Saskatchewan, and Ontario. The Manitoba provincial government stated this move is part of an effort to reclaim energy sovereignty amid ongoing trade dependence on the U.S. However, the decision may leave Manitoba Hydro facing up to CAD $25 billion in debt, prompting the company to propose an 11% electricity rate increase, starting in 2026 to offset revenue. Losses residents in Manitoba and Ontario may face increased financial pressure as electricity prices rise during a time of climbing living costs. The exit from the U.S. energy market also presents long-term questions for Canada regarding energy security and export diversification. Amid rising trade and political tensions between Canada and the United States, former President Trump has repeatedly referred to Canada as the 51st state. This rhetoric has raised concerns about bilateral relations and Canada's national security. Canadian Prime Minister Mark Carney publicly rejected President Trump's remarks, emphasizing the importance of defending Canada's sovereignty and independence. He also called for increased defense spending and reduced reliance on the U.S. in security matters. Both the Liberal and Conservative parties have expressed support for strengthening national defense and diversifying international partnerships. In Canada's Parliament, some members questioned whether NATO would intervene in the event of a conflict between Canada and the U.S. Under Article 5 of the North Atlantic Treaty, NATO responds only when a member is attacked by an external force. As such, a dispute between two NATO members may not prompt intervention, raising concerns about Canada's independent defense capabilities. Many Canadians have expressed anxiety about the future of the country and its relationship with the United States. Citizens are urging the government to strengthen ties with other international partners and invest in national defense to safeguard sovereignty and security. Canadians are increasingly aware of the need to reduce dependence on the United States and strengthen national autonomy. U.S. tariff policies and controversial statements by President Trump have fueled a wave of nationalism and a call for broader international engagement. A survey by Angus Reid found that 91% of Canadians support reducing reliance on the U.S., while 90% oppose the idea of Canada becoming the 51st state. In response, many citizens have joined Buy Canadian campaigns, boycotted American products, and canceled travel to the U.S. apps like MapleScan. And Buy Canadian have grown in popularity, helping consumers identify local products. On the political front, Canadian parties are advocating for increased defense spending and stronger relations with international partners. However, efforts to diversify markets and reduce U.S. dependence face several challenges, including high defense costs and geographic distance from alternative trade partners. American farmers are enduring a brutal economic fallout from trade wars with exports, collapsing production costs, soaring, and no solutions in sight. Can the U.S. agriculture sector survive this disaster? Sorghum exports to China have dropped 95%. In just 2 months of 2025, U.S. sorghum exports plummeted from 1.4 million tons to just 78,000 tons compared to the previous year. China once bought 90% of U.S. sorghum, but the market has vanished almost overnight. Other major crops like soybeans, corn, and wheat are also suffering, with prices falling and stockpiles growing. This sharp decline in demand is leaving U.S. farmers with millions of tons of unsold crops in silos, significantly hurting cash flow. The lack of buyers is pushing family-owned farms to the brink of extinction, especially as prices continue to plummet with no market alternatives in sight. China has raised tariffs to over 125% on a broad range of U.S. agricultural products, including soybeans, pork, corn, cotton, and dairy. In addition, the EU has also imposed 25% tariffs on key U.S. farm exports, like soybeans and processed pork, in retaliation for U.S. steel tariffs. Countries like Brazil, Argentina, and Russia are now filling the gaps left by the U.S., signing long-term trade deals that are shifting global supply chains. Permanently, farmers are seeing their once dominant positions in global markets erode with tariffs, pricing U.S. goods out of major markets like China. The agricultural sector faces long-term structural losses that will be hard to recover from. American farmers are now competing with cheaper products from other nations, leaving them vulnerable to further losses. A New York dairy farmer is facing an additional $2,200 in costs for livestock feed due to new tariffs on Canadian imports. Prices for fertilizers, seeds, and machinery are all on the rise because of tariffs on U.S. trading partners, putting immense pressure on farmers' budgets. Meanwhile, crop prices are falling, creating a double squeeze on U.S. farmers' profits. The escalating costs of production are making it increasingly difficult for farmers to turn a profit. with the prices of essential farm inputs like feed and fertilizer rising and crop prices declining.